Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is a continuing Analyze Out Loud video based on YouTube subscriber requests to look at various companies, and the one I'm going to look at today is Sherwin-Williams Company. Now, I consider this to be a very interesting example to cover for several reasons that I'll develop as I go through this video, but what I've done here, I've taken prices off of the graph, and all we're looking at here are the company's earnings and dividends going back to 1999. And a couple of things I want to basically focus your attention on. One is that this company has had a very excellent record of growing earnings at a rate of about 13.5% going back to 1999. I do want you to focus on the two recessions because obviously this is a paint company and recessions can obviously affect things like new home construction and so on. But they had a moderately down year in the 2001 recession, down about 12% from 2000 to 2001. During the Great Recession, they actually had two down years, minus 10% earnings growth in 08, followed by minus 9% growth. But if you compare this to, other companies, home builders and things like that, this was really exceptional because I guess you could say, people that have existing homes still, were buying paint and painting the inside and the outside of their homes. But then following the recession, and this is what I really want to focus on, I want you to notice that their earnings growth rate has accelerated dramatically since coming out of the recession. So I'm going to drop this to an 8-year graph. And what I want you to notice is that the growth rate over this period of time is 18.8% per annum. So the slope of this line is accelerating by almost 19% a year. But the PE ratio, valuation reference, is also a PE of 18. If I go back to the long-term graph, you've got a much lower growth rate. Here, the valuation reference is actually a PE of 15. Now, that's important when I bring monthly closing stock prices onto the graph. So I'm going to start by adding monthly closing stock prices. And I want you to notice how closely the price followed and correlated to this PE ratio of 15 when the company was growing at around 13.5% a year. But let's go ahead and scroll back here a little bit and let's bring this back. Actually, I'm going to bring it back one more year. Let's bring this back to what Sherwin-Williams did from 1999 to 2011. I want you to notice their earnings growth averaged about 9% during that period of time. And you can see a little more detail here. You can see how closely the price tracked. The 15 PE was kind of a standard. There were times when it went slightly below it and times when it went slightly above that. But clearly the price went at a 15 PE. It got undervalued during the Great Recession like most stocks did based on 2 negative years of earnings. But then as I move this scrolling out here to the future more, you see the growth rate accelerates to 13.8%. And then if I drop that again to this 8-year graph, now we end up with growth above 15%. And what FastGraphs automatically does when growth goes above 15%, we utilize the P equals growth rate. So the orange line in this graph would essentially represent a PEG ratio of 1, if you will. That's if the price was touching the orange line, it would be trading at 1 times earnings growth, if you were, a PEG ratio of 1. I'm going to go ahead and add the normal PE line here because what I want you to see is that when I look at the long-term graph where I'm using a 15 PE ratio, Sherwin-Williams looks extremely overvalued here. But that's based on valuing it at a normal 15 PE based on using the Graham-Dodd P equals growth rate extrapolated formula, kind of our middle formula, if you will. When I go back to the 8-year graph, all of a sudden we're looking at a much higher growth rate and a much higher valuation. Now, there's a couple of things interesting about this. One is the normal PE has averaged pretty close to 25, 24.5. So the blue line's a PE of 24.5. And you can see that's been a very, I'll call it normal valuation for Sherwin-Williams over this time frame. And that's kind of critical, but it's also related to the fact that the company's grown earnings at 18.8% during this time frame. So let's go down and look at the company from a futuristic point of view and look at the analysts. Now, this is a well-followed company. There are 24 analysts that do expect high growth this year, growth at about 27.8%. But those same group of analysts think growth is going to slow down to 15.9% over the next year, and then they believe it's going to slow down to 15.41%. So that's, still gives us almost a 20% growth rate. So now I'm using a PE ratio of 19 13.7 as a valuation reference. If I go to the normal multiple, which is that PE of 24.5, Sherwin-Williams looks very attractively valued right here, especially with a growth rate of 19 or 20%. But here's what I want you to understand. If I go to the custom, I'm going to skip the trend line graph and go right to the custom graph. This is the part that I want the reader or the watcher to be basically fully aware of. Long term, they expect, they being the analysts that following the company, expect 13.6%. Now, this falls below that 15% threshold I mentioned earlier. So if I combine near-term estimates with this long-time trend line of 13.6, this is what Sherwin-Williams looks like. But now we're applying a 15 PE ratio. And, you know, I still have the 25-ish PE ratio. It's actually 25.7, the way this graph is drawn here, which would mean that you could generate some very nice rates of returns if that PE ratio held up. But if we start getting any shrinkage in the PE ratio, if it starts going back to normal PE ratios, you know, 15 to 16, let's say, you know, you'd be looking at very low rates of return going out to 2023 if we actually had a reset of the valuation. So it's really the question that the investor really needs to think about and answer. You know, you're looking at an acceleration of growth, which definitely moderately justifies this acceleration in valuation here, where you have much higher PE ratios, you know, since 2011 than you historically have. But let's look at some other metrics. Let's look at operating cash flow from both a long-term perspective as well as this 8-year perspective. Once again, we see a pretty good correlation at around 12 times cash flow. I shorten it to a 8-year graph again. We've got operating cash flow growing at 17%. And once again, the valuation looks reasonable, moderately overvalued. But keep in mind, these should always be looked at as a range. We have to draw them as a precise point, but you ought to be always thinking that slightly below the orange line and slightly above the orange line still would fall into what I would call a valuation corridor. So in near term, it looks attractive. When I go out to the forecasting graph, once again, cash flow is expected to slow down. If I go to the 3 to 5 year trend line growth, and then again combine the specific with the trend line, we're back down to a 13.6% operating cash flow. Now let's move on to another valuation reference. Let's look at EBITDA and see how Sherwin-Williams stacks up on EBITDA. And again, if I look at the short-term graph, the normal price to EBITDA has been about 14 over this time frame, and the growth has been 17. If I lengthen the graph, the normal price to EBIT has been about 9. And what I'm really trying to get across here is you had a lower growth company back here, so you really got to shift. If I was able to draw a line on the graphic right here, you can see that this company went into overdrive, which partially justifies these current high valuations. But nevertheless, these valuations are higher than normal. And the real question that I think you need to ask yourself going forward is Sherwin-Williams going to be able to continue to grow at rates above 14 or 15% at these 16, 17% ranges like are being forecast? EBITDA just under 15%, although the long-term growth rate is even lower at 13.6%. But when you go back to adjusted operating earnings and look at forecasts, the long-term, the specific near-term growth is about 19%. The long-term trend line is about 13.5%. But that means this stock could have good valuation for the next couple of years. Now, what's really interesting when I'm looking at these estimates and when I'm looking at the analyst scorecard based on the 1-year and the 2-year estimates, I want you to notice with a 10% margin of error for the 1-year forward and a 2% margin of error for the 2-year forward, the analysts have virtually hit this within those margins of error ranges. You can see they've been very close. On a 2-year forward, the worst miss was 7% on the downside, and the company actually gave a 17% beat, just under the 20 threshold. On the 1-year forecast, again, you see very close. These analysts have been very accurate in terms of forecasting the growth of this company. So from my point of view, I think Sherwin-Williams is a great company. I think its operating history has been awesome. If you look at it as a long-term investment compared to the market, it's been significantly above average, you know, going back to 1999. If I shorten that time frame for these last 8 years that I've been showing you on this video, it's dramatically outperformed the S&P, and I think this is important because because the S&P has had really significantly above average performance during this, what I'll call post-Great Recession. I'll go one more calculation. I'll go down to the 11-year, and the reason I stopped at 11, I'll actually go to 12. That's coming out of the Great Recession, where the S&P also did real well during this time frame. And once again, you see that Sherwin-Williams did almost twice as well. The point is, it's not crazy valued based on its recent operating results, moderately overvalued at perhaps worse, but the real key is what's it going to do in the future? And that's the question that I think you really need to answer. You can go into the company's website, look for presentations. You can go into other sites like Seeking Alpha and look for articles on the company, etc. But the key point I'm trying to make here is that the valuation of Sherwin-Williams makes some sense based on recent historical growth. Anyway, this has been Chuck Harneville saying thanks for watching. If you find this analysis interesting, would like to learn more about fast graphs, call us at the number on the screen or email us or log on to www.fastgraphs.com. Thanks for watching.